Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Hey, everybody. Back with Olivia doing a special Q&A episode. So at this point, we've thrown a lot of content at you and at everybody, and we've accumulated from Olivia as well as from some of our other listeners some follow-up questions, just things people wanted to clarify in prior episodes. So we are devoting this whole episode and maybe even the next two episodes to Q&A, just questions and answers on a variety of topics. So with that, Olivia, or I guess I should say, and with that, Olivia is going to be our designated asker. So some of these are her questions, but she's also asking on behalf of everybody. So with that, Olivia, I'll turn it over to you.
The first question I have is a clarification question of why does the balance sheet always balance? We've talked about the balance sheet in pretty large depth, and I understand that it's always the goal for it to balance, but ultimately, I just want to clarify why it is one and why it ultimately does happen.
The short answer is the balance sheet always balances because when the first accountants were setting up the existence of the thing, they wanted it to. So there's nothing like intrinsic about the physics of the world that make it balance, but they were basically like, hey, we want a way of accounting for everything in, this complicated business. And we want a way of checking ourselves to make sure that we actually have included everything. Because you can imagine if it didn't balance, it might be a lot easier to forget, double changes to line items or various things like that. And so the basic idea is whatever is going on in your business should either be, reflected as an asset, as a liability, or as equity. And the definition of the way we're thinking about equity from a book value and from a balance sheet context, where book value basically just means the balance sheet value, like what the balance sheet says it is. The way we think about the balance sheet is that if you have assets that exceed your liabilities, then you have net equity. And the opposite is true, where if you have assets that exceed your equity, then you must have some liabilities somewhere. So no more complicated reason than that.
Okay, that makes sense. And then second, I had a question of, so I understand I guess kind of the intersection between the cash flow statement and the balance sheet. But one thing that's been kind of difficult for me to grasp, and I don't know why this has been particularly difficult, but we've talked about it a lot, is the concept of retained earnings, which I feel in a lot of the questions that we've gone through in previous episodes, I just haven't been able to grasp when that, I guess, is the solution. So yeah. I was wondering if we could just go over that a little more. I know it's in the balance sheet, and that if this is correct, it's the amount of profit that a company has after they've paid off all their costs, their taxes and stuff like that. But I was kind of just wondering if we could go over it a little more, just because I've had that trouble grasping.
Yeah. Retained earnings in any given period is whatever the retained earnings was in the last period, plus whatever your net profit was. And equity on the balance sheet is a really finicky thing, because I feel in my head, when I was learning this, I felt like equity was a good thing, and more equity is always good. And in the context of how the balance sheet works, it depends, because you can get equity from two places. One is you can get equity from raising money from investors, and that's not retained earnings. That's just common stock or, whatever. But it's basically if I have a startup and I'm raising some money, that isn't necessarily it boosts your equity on your balance sheet, but it's not this special great thing. It's just you raise some money, so you increase your equity because you gave it away to somebody, and then you have some cash. Retained earnings is the good equity, Retained earnings is your accumulated profit since inception, basically. So every year, your retained earnings goes up by whatever your net profit was. So if you were thinking about doing like an Excel model where you had to figure out what your retained earnings was, the way that that formula works is it's last year's retained earnings plus this year's net income or net profit.
Okay, that makes sense.
It is very rare. I don't think like any interview I've done or been a part of, people are like asking you about retained earnings. It's more like a modeling mechanic because retained earnings is this balance sheet item and it's basically tracking accumulated profit over time. But nobody's ever like, what's the retained earnings of this business? Like, I care so much about the retained earnings. And it's more like, well, we got, cash from somewhere. We got assets from somewhere, and we need an offsetting line item in our equity to account for it. Okay. And so it's basically like whatever cash or like new assets we got as a result of the business performing profitably or unprofit, or like assets we're losing because it's performing unprofitably. Retained earnings is kind of like the plug on the balance sheet that solves that. And so, yeah, like the formula for this year's retained earnings is last year's retained earnings plus this year's net profit.
Okay.
And I think the reason why when we talk about it, it keeps coming up all the time is that is a primary linkage between income statement activity and balance sheet activity. Right. So every time we first figure out what's going on in the income statement, and now we need to adjust our balance sheet, every time we're looking at a change in time where there was some income statement activity, there is always a retained earnings figure. Sometimes it's zero, but there's always a retained earnings change that comes directly from whatever the net income was in that period.
Okay, that makes sense. It was helpful to hear like why I guess it's like been such a like not a lot like a big factor, but like been a factor in the
it comes up every time you care about translating income statement activity to balance sheet changes.
Okay. And then kind of going off what you said about, I just had a question about, I guess, the interview process. Are there any things that we've covered that you think that you would like classify as more valuable to know for like prepping for interviews or like for those interview questions?
A number one leading interview question is on depreciation. And people always ask about depreciation because it requires an understanding of how all three statements work together. And I feel like pretty much every example we've done has something where we talk about impact to the three financial statements. And so your ability to like at a high level understand what the three financial statements are and how they work together, or how a change in the business affects all three, is a version of probably 40% of the interview questions you're going to get. And then we also spend some time talking about the difference between debt and equity, and just like understanding how raising equity impacts your three financial statements is different from debt. Primarily, like part one of that is that debt is a liability, not equity. So it's in a different place on your balance sheet. But part two is that debt comes with interest payments, and interest payments affect your income statement. And so it affects everything.
Okay, that makes sense.
So that is like one category of interview questions. A second category of interview questions is what I'll call high-level business comparisons. Like, I think one common trope of an interview question would be like, so you're running a pizza place, or you're thinking about buying a pizza place. Tell me how you'd think about valuing the business. And we haven't really talked about valuation in nearly the detail that we will yet.
When I was going over some of the previous episodes, I was kind of just a little confused about the EBITDA, and I got lost with the word math. So I was wondering if we could go over that again?
Yeah. Yeah. And letter math is very fun. We all love letter math. EBITDA stands for earnings before, and then the four letters that come after that make up the ITDA are interest, taxes, depreciation, and amortization. And for our purposes at this stage, I'm going to lump depreciation and amortization together because conceptually they refer to the same thing. So as a refresher, depreciation expense is basically a way of averaging out upfront costs for things that you expect to provide value over time. The classic example is a factory. If you spend a bunch of money to build a new factory that you think is going to last you for 10 years, depreciation is a way of letting us average out that upfront expense evenly over 10 years. And so it's a non-cash item. It's literally like this line item that we made up. And we made it up to account for the fact that we want even amounts of expense every year for 10 years. Amortization is the exact same concept as depreciation, but it refers to reducing the value of intangible assets. And that's why I'm sort of lumping it together. So one example of what makes an intangible asset would be something like the value of a company's brand. So Coca-Cola, if someone just replicated their manufacturing facilities, if they had the same distribution channel, if they had the same ingredients that went into the bottle, but when they sell something, it has a different label on it, they will sell fewer of that thing. And so there's some value for companies that's associated with their brand. That's one example. A second example is in a context where you buy a company, what their equity value on their balance sheet says has almost nothing to do with the price at which they'd be acquired. And so in accounting land, we have this item called goodwill that is basically a made up item to make our balance sheet balance when we're acquiring businesses. And amortization basically allows you to reduce, like structurally reduce the value of an intangible asset over time. So that's why I just want to lump depreciation and amortization together. Almost never will you hear someone talk about EBITDA or EBITDA. Interest expense is based on debt you have and interest that you owe on debt. I will say sometimes you can have interest income. You can have positive money from interest. It's not always negative, because one thing that a lot of companies do is they have a lot of cash and they invest the cash. And so even if it's not like, even if you aren't an investment firm, you might put it in some low yielding, low risk thing. Like you might buy some treasuries rather than just leave it in a bank account. And so you can have some positive interest income for that. Taxes is the last thing you calculate before earnings. So earnings before tax is basically you layer in all these expenses and then you apply a tax rate to it. So those are what all the letters mean. And just orienting us, EBIT is operating profit. So when people talk about operating profit, you see operating income on an income statement. That's almost always EBIT. And that means that when you see operating profit, depreciation and amortization expenses are real expenses that are flowing through our income statement. And so those will be included as expenses when you calculate EBIT. So one question you might ask is like, well, why the hell do we care about EBITDA? Like, when would we ever add those numbers back in? The real reason why people care about EBITDA so much as a valuation metric is that it tries to strip out all of the non-operating expenses from the business. And so when you hear somebody talk about like amortizing some intangible asset or depreciating a capitalized expenditure, those all relate to changing the value of balance sheet items, right? Like we built a factory, we put the value of that factory on our balance sheet, we depreciated the value over time. So whenever you see a depreciation expense, that is reflective of changing the value of a balance sheet asset, not what happened in the performance of your business during the period. So that is why a lot of people really like talking about EBITDA as a valuation metric, is it's kind of like the purest, quote unquote, operating metric that basically tries to look at the profitability of the operating business that you've been running and strip out, the impact of some of these other things. EBITDA, you want to exclude interest expense because your interest expense is entirely dependent on your decision to borrow debt versus like give away equity, right? Like if I have interest expense, that's because I borrowed some debt and I'm owing interest payments on that debt. But that was a decision I made to borrow the debt versus go out to equity investors and promise percentages of my company to someone else. And so the existence of interest expense is totally unrelated to the core performance of the business. And then lastly, taxes are generally stripped out because one, there's some complicated reasons why different companies have different tax rates. Like notoriously, like large pharmaceutical companies have tax rates that are much lower than the standard 21% corporate tax rate. But the other reason is countries. If you're trying to compare a business in France with a business in Hong Kong, those companies operate in very different tax regimes. And so stripping out the tax rates that they pay allows you to compare the core businesses on kind of an apples to apples basis.
Can we quickly go over what does the gross margin show?
Yep. The gross margin, which is calculated as gross profit divided by revenue, basically tells you that for every dollar of revenue that you're collecting, how many pennies do you keep as kind of marginal revenue from selling that item? So as a quick example, if you're selling, a cup of lemonade for $2 a cup, and if the sum total of the good, the cost of goods to produce the lemonade was, call it $1, then your gross profit would be $1. Like you're selling something for $2 that it cost you $1 to make. And so for every cup you sell, you're making $1. And when we talk about gross margin, that basically is just trying to compute gross profit as a percentage of revenue. So in that case, $1 of gross profit for every $2 of revenue is a 50% gross margin. And the way that analysts like to use that gross margin figure is basically trying to extrapolate if this business structurally grows, like if their sales go up by 10% or go down by 10%, I want a quick way of thinking about how operating profit pre-tax is going to be affected. Because sort of the thinking is that the fixed costs, like in this lemonade stand example, the cost of the stand doesn't change, depending on whether you sell more or less. Like at some point, if you're like quadrupling the size of your business, you need, there's more infrastructure involved. But just like as a rule of thumb, the way people think about it is like, let's say your sales go up 10%. By how much is your gross profit going to increase? And so the gross margin kind of helps you think about that.
Okay, that makes sense. So just kind of clarifying the gross margin is important because it helps us determine how much, like you said, our sales increase when
and just like to give some examples, would you guess that like so let's take Facebook, or Meta owns Facebook, and for the sake of this example, the preponderance of Meta's revenue is from advertising sales. So basically they serve up a bunch of ads, and when you go on Facebook or Instagram, or WhatsApp, and you're scrolling through your Instagram feed and you see an ad, if you click on that ad, or even just for like displaying the ad, Meta gets some money. Do you think that is a high margin business or a low margin business?
I want to say low margin business.
Tell me why.
Because, I mean, if you get a percentage for, I guess, every click on an ad, I feel like there will be like a lot more ads than you would get clicks. So therefore it would be lower.
Well, so let's say they're charging, $1 for this ad. What do you think it costs them? It costs Meta to like serve up that new ad when you're like scrolling in your feed.
I would say little to
Yeah,
no
it costs them
money.
basically
Yeah.
nothing.
Is there something else I can help with?
Sorry, my wife
It's
is
okay.
barking at me. Yeah, it's little to nothing. So for every dollar of ad revenue that Meta is receiving, they're getting almost $1 of gross profit.
Okay, so then it will be high.
Exactly. Yeah. So it's
Okay,
a
that
very
makes sense.
and software businesses tend to be valued very highly for two reasons. One, they tend to be very high margin businesses, which is basically to say, if the software exists and it's like hosted in the cloud somewhere and you sign a new customer, it costs these companies almost nothing to sign that new customer, or to provide the service for the new customer. And so it is a very high margin business that is also very scalable, right? Because if you have 100 customers and you have the software infrastructure to, provide this software service to 100 customers, you don't really have to do that much extra to, provide the same service to 500 customers or 1,000 customers. And so the idea with software businesses is one that they can scale really quickly. Like Instagram can go from 1 million to 1 billion app store downloads pretty quickly. And once they're downloaded and making money, you're making a lot on every dollar of revenue you produce. So high growth and high margins are both like wonderful things for valuation and how a company would be valued.
That makes sense. And then I also had a question about interest and why, and if we could go over again why interest is tax deductible.
Yep. The short answer is all expenses are tax deductible. If you pay salary to employees, that hurts your profitability, right? So your profit goes down. And so your profit before tax goes down and you pay fewer taxes off of it. And the whole idea behind like specifically calling out interest expense as tax deductible is it's the one decision in financing a company that isn't actually related to the performance of the business, the running of the business, where you can impact the taxes that you owe.
Okay.
So that's kind of like the one special thing about it is pretty much everything else that's tax deductible at some point is related to the actual day-to-day operations of your business. But interest is a little bit special because your business could be doing whatever it's doing. I could borrow money, do nothing with that money. Like I could just be sitting on it and I'd owe interest on it. And that interest expense can reduce my profit before tax. So there's nothing intrinsically special about it other than it is a popular interview question because people often forget about the tax deductibility of interest when they're evaluating things like the cost of borrowing.
Okay. Okay, that makes sense. And then another question is why is net working capital usually increasing?
Yep. And so this is kind of an interesting one. I enjoyed reading this from one of our listeners, which is if you think about net working capital as your current assets minus your current liabilities, you might expect that like over the course of like the world, like there are all these people that have like accounts receivable and all these other people that have accounts payable, and your receivables are due from somebody and your payables are due to somebody. So the logic is like, well, shouldn't the net, the net working capital of the world be zero? And that actually is not the case. Almost every company has net working capital that is positive and structurally, if it's a growing company, it's structurally increasing over time. And the biggest reason for that is that accounts receivable is money that your customers owe you. So it's basically stuff that will be revenue. And accounts payable is stuff you as a company owe to somebody else for part of a process that went into costs of running the business. And so if your operating profit is positive, which if you were running a business, at some point your operating profit really needs to be positive because otherwise you'll run out of money and the business will fail. Then if you're making more dollars on every sale, like on revenue, then you're making across your, not only your cost of goods sold, but also your kind of like general and administrative and fixed costs. As long as you're making positive operating profit, then that means your receivables, which are based on revenue, are structurally always going to be higher than your payables, which are based on your costs. So as long as you have as long as businesses all over the world are positive margin, businesses all over the world on average will have positive working capital. And if, these businesses are growing, then your net working capital is increasing over time because your whole business is growing. So your revenue is growing faster than your costs. Therefore, your receivables are growing faster than your payables, as long as you have a positive margin business.
Okay. So then if your receivables weren't growing faster than your payables, then you would have a negative net working capital?
Well, and it's not just if your payables are growing faster than your receivables, your net working capital might today still be positive, but it's decreasing over time.
Okay.
And that's what you care about, is basically your change in net working capital over time is an indicator of cash that you thought you were otherwise going to have in that period that you do or don't have.
Okay.
So that is to say, if your net working capital is increasing from this year to next year, that means you will have more tied up in more value tied up in working capital that isn't cash in next year than you have this year. Does that make sense?
Yes, that makes
Like
sense.
basically, let's say your receivables go up from this year to next year.
Okay.
Then all else equal, if your receivables went up, your cash, you thought, maybe you thought it was going to go up, whatever you thought it was going to do, it isn't as high as you otherwise would have expected because there's this extra value that's tied up in receivables, which is money that people owe you, but they haven't paid you yet.
Okay. That makes sense. And then another question from a listener is if you could talk about accrued expenses versus accounts payable.
Yes. And so this one I think is a little bit on me because we sort of explained it, but just to put a fine point on it, one, you might see line items that are called like accrued salary or accrued, like there's like all these other words that people could use, but you'll always see it in the current liabilities section if it's something that we care about. And it'll say accrued, something or other. And kind of the rule of thumb of whether something belongs in accounts payable or whether it belongs in this other line item, let's call it accrued expenses, is whether that expense is related to producing and selling your product. So a lot of people tend to think of accounts payable as money you owe for work or for services that went into producing your product. So if this is money you owe that you recognize that is like cost of sales or cost of goods sold, so you recognize the cost, but you haven't actually paid it yet, that is accounts payable. And accrued expenses more often relates to items that I'll call it are not directly related to cost of sales and might be related more to SG&A or selling general and administrative items. So the lemonade stand example we used is that if you buy a bunch of lemons and ice from a store, but you don't pay them, you basically get it on credit and you owe them the money, tomorrow or next week, that's accounts payable. But if you kind of borrow the table for your lemonade stand from your friend, that's not something that is directly part of cost of sales. And so, when you have this ledger that's like, oh, I have to pay, someone else rent for the table, that is something that would go into accrued expenses.
And then that makes sense. So then that wouldn't go into accounts payable just because you didn't use it to make your product or to produce your product. Okay.
Exactly. And the reason for the distinction from a forecasting perspective is to the extent that our fixed costs aren't oscillating by quite as much as the business grows. If I'm if I know what accrued expenses was for each of the last 3 years, I might predict next year's accrued expenses to be about the same as this year's. Whereas if I'm trying to predict next year's accounts payable, I care about how much my cost of sales is expected to grow, right? Because the more cost of sales I have, the more likely it is that among all of those, products that I've sold, that if I had payables off of a smaller baseline of products that I sold last year, and I have more products that I sold this year, my payables is probably going to be higher as well. This gets a little bit into a forecasting topic on payable days and receivable days and inventory days, which is basically ways of estimating and forecasting these numbers. We haven't talked about that yet. So we will talk about that in a future episode. But for now, if you're wondering, why the heck do we have all these different things and why do they matter? It predominantly is something that we care about for forecasting purposes. That does it for today's episode. Thank you so much for listening. And remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.